Hi, my name is Ruperto Ancajas. I'm a portfolio specialist at Foord Asset Management Singapore. Today, we're going to be talking about the Foord International Fund. It's over 27 years old, and it seeks to outperform inflation plus over the long term. And recently, it won a 5-year Lipper Award for good performance as of 2022. Over here, we have Brian Arcese, a portfolio manager of the Foord International Fund. Brian, what do you think led to the outperformance over 5 years?
Yeah, no, it's a great question, Ruperto, and obviously, I mean, we were happy to have received that award for the 5-year period of performance, though for us, it's not really what we're aiming to achieve, but it really is important to unpack the performance that led to that, and for us, it was really the environment more than anything in how we changed or managed the fund. I mean, as you know, the fund is conservatively managed, and we have two primary goals. The first is to preserve capital, and the second is, as you mentioned, to deliver that inflation-beating or real return through a full investment cycle. Now, interestingly enough, if you were to rewind to prior to that 5-year period, from the market bottoming in sort of March of 2009 after the global financial crisis up until relatively recently, we actually came through what was then sort of the longest bull market in modern history in equities. And that's an environment where our conservatively managed fund doesn't tend to perform well, particularly if you're measuring it against an equity benchmark. But what was kind of so marked, I think, about that 5-year period ending last year was that you had two very volatile periods within it. So the first being 2020, which was obviously COVID, where you saw a big market fall in the first quarter and then a significant rebound. And then also you had 2022, where you saw both equities and credit fall by 15 to 20% over that period. And the fund, due to its conservative nature, we can talk a little bit more about how we manage during that period if you want to get into it. But over that period, the fund was able to achieve a positive return. So it's really in how we've managed the fund since its inception, as you mentioned, 27 years ago. Right. But it's during periods of volatility, uncertainty, and market correction where the fund will really show its stripes. And that's the most recent 5-year period that we've just exited.
So let's zero into 2022. What was the environment and what was the strategy? How did the year start and end for Foord?
Yeah, so it's a great question. I mean, if you look back to the beginning of 2022, you had inflation in the US that was running at 7.5% plus, but the Fed funds rate was only 25 basis points. I mean, the bond market, the Fed was well behind the curve. The bond market in general was as behind the curve as the Fed was. And in that environment, you could see, for example, that interest rates needed to rise. They needed to rise materially, and they probably needed to rise materially relatively quickly. So if we all go back to kind of our university days, and when we understand that when yields rise, bond prices need to fall. And so for us, it was a very sensible time to be completely absent credit, for example.
Right.
At the same time, well, equities are a good hedge against inflation, that's 7.5% inflation. Rising rates can be a headwind for equities. It creates a lot of uncertainty for investors. And so when we were absent credit, we were also very conservatively positioned within the equity portion of the portfolio. And then the final piece that I would say during that 2022 year is that within equities, we had positioned the portfolio a number of years earlier to really be protected against inflation. I mean, we chatted about how the second piece to our benchmark is really delivering that inflation-beating return. So 20% plus of our equity book were really in commodity-linked equities. So these were securities that actually had a positive return during 2022, despite the market overall being negative.
And what about fixed income over the last 5 years? Let's go back to the 5-year bit. How has the allocation of fixed income evolved over that, and how has that kind of contributed to performance?
Yeah, so fixed income for us, I mean, if we look not only over the past 5 years, but even slightly before that period, obviously we've had a third of global sovereign bonds at points in time, and even the corporate bond market to some extent trading at negative yields. So for us, those are types of investments that really wouldn't find their way into our portfolio. I mean, we don't really fundamentally believe in something where your best guaranteed return is that you lose a set amount of capital. And so during that period, we were really absent, significantly sort of underweight fixed income and credit. And as we moved through 2022, you saw that as rates needed to rise materially, it also wasn't yet time to kind of move into that fixed income bucket. When we look today, I mean, we relatively recently have seen the 10-year kind of the highest it's been in 15 years. Both nominal and real rates are either at or nearing a point where they're providing a real return to investors. Right. So fixed income to us it's gone from 0 to sort of 10 to 15% of the portfolio. It's quite path dependent. I mean, it could certainly be far higher than it is today.
What about gold? How does that feature in the portfolio and historically and maybe going forward?
Yeah, so gold, it has proven its kind of worth over time as a hedge against volatility and a hedge against geopolitical risk. It's often people talk about gold as a hedge against inflation, and it really isn't. I mean, it doesn't really act as a good hedge against inflation at all. But it does provide a ballast to the portfolio during periods of uncertainty. And that's really what we've seen, not only over that 5-year period, but previously as well. So we have a modest allocation to gold at the moment. It's about 5 to 6% of the portfolio. But it really has served us well over time during those periods of volatility and uncertainty, which are really difficult to predict, which is why it's sensible to have that hedge more consistently in the portfolio.
Let's talk about liquidity. Is liquidity an investment decision or the result of not investing?
For us, it's an investment decision. I mean, liquidity or cash in the portfolios cash in and of itself is an asset class that we can invest in. So if we look at 2022 as an example, we were kind of significantly underweight or conservatively positioned on the equity side. We didn't feel it was sensible to be invested in fixed income with how much rates needed to rise. So we had more than a third of the portfolio invested in cash. So that cash does provide, particularly now that rates have risen, cash does provide a return to the portfolio. But it also gives you the opportunity as a portfolio manager to deploy that cash during periods of volatility. So when markets do correct, we can then redeploy that cash into what are then more attractive investment opportunities.
Okay, well, thanks for that. Thematically speaking, what are the current things you're looking at in the portfolio?
Yeah, so from a thematic standpoint, I mean, we have investments really, the portfolio is quite diversified from an equity standpoint across regions, geographies, and sectors. We do have investments, as I mentioned, in this commodities complex. So commodity-linked equities, for example, are still sort of in that 20% range as a part of the portfolio. They do offer a real-time hedge against inflation, which to us is still a sensible place to invest. Now, I do want to say these commodity-linked equities for us aren't all miners, for example. They would also include companies kind of in the precious metal space, agricultural commodity space, the energy space. So it's quite a diversified basket, and a basket that has historically performed well even during periods of economic downturn for the individual securities that we own in the portfolio. Okay. But if I take a step back and look at the asset allocation kind of generally where we sit today, if you want to beat inflation over time, you need to be invested in equities. But you need to be cognizant of what the valuations are. So for us, 55 to 60% of the portfolio is in equities today on a net basis. Right. As I mentioned, we have sort of 10 to 15% in fixed income. We have the 5-6% allocation to gold, as I mentioned, and then the balance is either held in cash or in synthetic cash that's created as a function of hedging kind of our overall equity portfolio.
Okay. From an ESG perspective, how are you looking at the holdings bottom up? How do you incorporate ESG while you're looking for stocks for this portfolio?
Yeah, for this portfolio and really for all of our portfolios, we incorporate ESG really at the beginning of the investment process. When we're doing the bottoms-up fundamental work on each of the securities, whether it's an equity or a credit, to consider for inclusion into the international fund or multi-asset fund, I mean, we're incorporating and looking at the E, the S, and the G, not only from a qualitative standpoint, but where we can, building those the quantitative standpoint into the underlying financial kind of models for each of the securities that we're considering. So for us, it's not research fundamentally first and then evaluate ESG second. It's ESG factors are fully incorporated into our research process for each of the securities that we evaluate.
Oh, thank you. Can you also talk about the long-term track record? This fund has been around for the last 27 years. How has it performed in terms of returns and volatility?
Yeah, so as I mentioned, I mean, the fund performs best, certainly relative to peers and relative to kind of our own benchmarks during periods of volatility, right? During periods of market decline. That's when the portfolio kind of earns its stripes, so to say. So over that 27-year period, interestingly enough, despite being conservatively managed and despite having about half of the volatility of what an equity benchmark has had, and during periods of stress having sort of less than half of the drawdown that an equity portfolio would have. I mean, over that full 27-year period, you're still earning more or less an equity-like return. So while we aren't targeting equities as our benchmark, certainly not in any given year, but what we've seen through full investment cycles and through the long-term history of the fund, we've been able to deliver that inflation-beating return, inflation plus 3 to 5%, which has also been in line with equities, but with half the volatility and half the drawdown.
Well, thanks, Brian. That was really informative, and that's something I think the investors of this fund would really want to know, that it's a fund really for the long term. And it's interesting, you know, being conservatively positioned has allowed the fund to outperform over the long term with half the volatility and the drawdown of global equities. So it's the long game for this. Thanks, Brian, for that. So there you go, folks. This is an insight to the Foord International Fund, which is 27 years in track record, and it's a global multi-asset fund that seeks to provide inflation plus returns over a full economic period.